Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Most mechanical system traders are trend followers and establish positions only after a substantial part of a market move has taken place. Over the years, trading systems based on moving averages, channel breakouts, and range expansion have been beaten to death and overexploited. People who use Edwards and Magee don't know any better. Charting that way is an art form. What we do is science. It's Tuesday, June 29th, 2010, and this is the MTA Podcast Series. And today's guest is Tom DeMark. Tom DeMark Sr. is president of Market Studies LLC and a former executive vice president of Tudor. He has served as special advisor to Stephen A. Cohen, SAC Capital, for the past 14 years. Mr. DeMark is the author of 3 best-selling books, New Market Timing Techniques, DeMark on Day Trading Options, and The New Science of Technical Analysis. He has spent over 39 years testing, trading, and teaching his market timing techniques to institutional traders and investors. Many of Mr. DeMark's indicators appear on 3 of the most popular professional data service providers, Bloomberg, Thomson, and CQG. Tom's resume includes consulting for some of the largest trading institutions in the world and to large fund managers, including Soros, Steinhardt Partners, Goldman Sachs, Lowe's Corp., IBM, Union Carbide, and Citibank. Known internationally for his mechanically driven, objective approaches to trading and timing the markets, Mr. DeMark has created numerous successful market timing models and indicators designed to anticipate market tops and bottoms. He has appeared regularly on television and radio. Tom DeMark, welcome to the MTA Podcast Series.
Great to be here with you, Ed.
We're just delighted to have you with us today. As usual, we usually start with some personal history in these interviews. I see that you went to both law school and business school. How is it you happened to end up that much education in that particular direction, and how did that get you into technical analysis? Give us a couple minutes of background there, would you?
I'll tell you, Ed, I couldn't find myself. I think, in retrospect, I look upon it as wasting time in college.
Really?
Yeah, I couldn't find. I had no direction whatsoever. So I tried both, graduate school of business and law school, and it was frustrating because my love and passion had been in the background, and that was trading markets. I started in the late '60s, early '70s, and fortunately, I found my way in 1971 with what turned out to be the fastest growing fund manager in the country in Milwaukee, Wisconsin. There were a group of 4 principals and 3 of us little grunts, and we grew to $3-4 billion. And back then, in the 70s, the early mid-70s, $4 billion was a lot of money under management.
Well, it still is in my book. But here's what I really want to know: how did you get from academia to that little money manager you're talking about? What happened in between there? What made the contact? What was the segue?
Well, there were some contacts I made while I was working. When I was in college, a German professor traded the markets, so he introduced me. My uncle was a trader, and in addition to that, my ex-fiance's sister's boyfriend was an aggressive trader in options back then. This is when options were very thinly traded.
Yeah.
So I got introduced, and also when I was in law school, I was working for Miller Brewing during the summer in the Equal Employment Opportunity Commission group, and one of the attorneys there was a point and figure chartist. So I was able to touch base with a number of people, fortunately, who introduced me to trading, and I moved on from there.
Okay, all right.
The thing that surprised me, there was just a shortage of information on technical analysis back then. Most of the indicators that were used were either moving averages or trend lines, and then secondarily, but more important, people used sentiment indicators such as odd lot short sales and specialist short sales and things like that to judge whether the market was overbought or oversold. There really wasn't much there. You mentioned initially, breakouts and range expansion breakouts, and those weren't developed until the later part of the 1970s. And channel breakouts, Don Sheehan did some work on that, but there wasn't much there. So there really was a shortage or dearth of information, and my role in my first job was to do a lot of original research, and that's what I did, and search out throughout the world. We had a commission budget of $15 million, and I was given a license to contact anyone, anywhere, and throughout the world, and have them come in and talk to us about their trading philosophy. So that's how I was fortunate. I mean, in retrospect, looking back 40 years, I think I've had the ideal job in the industry. I mean, no one else has. And I'm not saying this pounding my chest, but nobody else has been fortunate enough or lucky enough to follow the career path that I have.
Yeah. Oh, that's neat. Listen, Tom, the purpose of these podcasts is not necessarily to teach anyone's system, or certainly not to advertise, but it's to give our listeners an opportunity to find out more about the person behind all the systems. Somebody wrote of you, his talent lies in creating winning systems, but is less adept at trading them himself. Those who can do, those who can't teach. Tom, I somehow don't think that old bromide applies in this case.
Well,
give us some insight into that.
I probably was quoted for saying that. I prefer to do the research, but I do associate myself with good traders. In the 70s, I was with the fastest growing company in the country. In the early 80s, throughout the end of the 80s, in the hedge fund area, which was just starting at the time with Soros and Steinhardt. Wasn't really Steinhardt, Fine and Berkowitz was the first, but then Mike Steinhardt and Soros, and then eventually Paul Tudor Jones and Lee Cooperman, who had been a friend for 35, 40 years with Goldman Sachs, in the last 14, 15 years with Steve Cohen. But there's also been other people as well. And no, I do trade. My election not to trade is more by choice, so there won't be any conflict of interest. But I don't profess myself to be the best trader, but I think I'm a pretty good trader. So
okay.
I think I may have said that to people because people ask me, what's your preference, trading or research? And it definitely is research. I recall I gave a presentation to about 300 people in Washington, D.C., and one person in the audience, when I opened up for questions, said, if you're so rich, if you're so such a good researcher and such a good trader, why aren't you rich? And I looked at him and said, I am. But it's not, I don't want, like I said, project the image that I'm a trader. I'm not, and I don't prefer to be a trader. My preference is creating techniques and working with the best traders in the industry to implement the techniques I develop.
Right. Something else I think you said, which I find very interesting, and it gels with a lot of things that we've talked about in past interviews, not you and I, but myself and other guests. You at least wrote, 99% of the people in trading are not creative, and they're not willing to rely upon themselves to make decisions. That's interesting. Why don't you talk to us a little bit about that?
No, I'm convinced of that. Just throughout my career, 99% of the people don't have time and have a disinterest in developing trading techniques. Most of them, are which I describe as are wide receivers. Quarterbacks are few and far between, and the people who create the indicator systems have a special creativity, I believe, or an interest in creating techniques that'll beat the market. Most of the people, like I said, who I've been associated with, who are excellent traders, have their own specialty. It doesn't mean if you're a good trader, you're also a good creator of systems. It's not. It's two different approaches at the investment business. And if you can meld the two together, you can be successful. I don't think I've ever seen, there may be one or two who are creative, create their own techniques, and then implement them. But it's usually a combination of these two, that research and then money management and discipline, which would be the trading portion.
Well, do you think that somebody with one skill can necessarily develop the other, or are they mutually, they never the twain shall meet?
They're not mutually exclusive. I think there's an overlap there, but really, it's what I found. The best traders, like Paul Jones and definitely Steve Cohen, who's I think the absolute best I've ever. I'm sure he's going to go back down in history as the absolute best trader in history. He's got an ability like Michael Jordan does, and you can't convey that, or you can't translate it into something down on paper. It's more a feel. It's intuitive and innate, and particularly with Steve, I think if he tried to instruct somebody in how he does it, it's just missing. You've got it's a God-given talent.
Is that the same thing that we think of when we talk about a trader being in the zone?
Yeah, definitely.
Okay.
It's not, and I know my shortcomings, and I was able, fortunately, I think people won't admit their shortcomings. And when you try to fight with the market, you're always a loser. So,
isn't that the truth? We're going to continue with Tom DeMark in a moment, but first a reminder that on next week's program, we'll have from Thomson Reuters, Jeff Chia as our guest. Tom, listen to this quote. I think we're going back to the basics. These guys have gone too far with the high-tech Star Wars technology like neural networks and chaos. We've come half circle. If you can draw a trend line properly, you can make money. If you can interpret an overbought, oversold indicator properly, you can make money. The things I found early on still work the same way. These rocket scientists have no idea what a trend line is. I think they're overlooking the basics. Now, I personally, yeah, you wrote that. That appeals to me. But I got to ask you, that seems to contradict the quote I read in the opening, which was, people who use Edwards and Magee don't know any better. Charting that way is an art form, what we do is a science. Obviously, you feel your approach lies somewhere in between the two extremes. Can you define this in between a little bit more for us?
Sure. The way I've always looked at the market is technical analysis. First of all, I don't consider myself a technician per se. I'm a market timer. Back in 1973, 74, I received the first two designations for the CFA program, the C and the F. But then I decided I'm not a pure fundamentalist, so I'm not going to go for the A. And then in the mid to late 70s, I became one of the first members of the MTA outside of the New York City area. And I was a member for maybe 10, 12 years. But I concluded I'm not really a technician. I'm a combination of the two, a hybrid trader, investor, researcher. I think fundamentals, obviously dictate and dominate the long-term trend of the market. But technical analysis or market timing is able to identify the wrinkles within that. So what I've tried to do is blend the two, having a research group and steep fundamentals, and then use my market timing tools to perfect that. Well, at the same time, technicians are chartists, and I break down the word chartist into two different words, chart and artist. So if you're a chartist, you're a chart artist. And I think there's three levels of analysis with charts. The basic level has to do with someone's perception of the market, and that introduces all your biases and news and your position in the market and everything else. And that can change from day to day. You could look at a chart one day, and if you remove the label, the next day you could have just the opposite interpretation depending upon which side of the bed you got out of. So it's too subjective. The second level of analysis I consider is indicator introduction into a chart. So if you have an indicator and you've back-tested it and it has good results in identifying possible tops and bottoms, you've introduced an element of discipline that's really important. And that way you've got the consistency as well. You can look at a chart one day and look at it a year later and draw the same conclusion. The final level of analysis, obviously, a systematic approach. And I do work with systems, but that's all internal. Most of my writings and everything has to do with the indicator level of analysis. Mm-hmm. I don't know if that answers your question, but it's the Edwards and Magee approach is great. Same with John Murphy. They've written great books, but I think it's a overall broad perspective. What you got to do then next is get into indicators and indicator creation, and then hopefully if you come up with a good set of indicators, you've got a systematic approach that you can apply.
No, I think that makes complete sense. I understand that absolutely. I think I do. Yeah, I understand what you're driving at. How's that?
Yeah.
This last major point in my notes may be a little controversial, but I wanted to touch on it. I understand that you lay claim to being the first person to rediscover Elliott Wave theory. Why don't you give us a little background on what you're talking about there?
Well, I don't know if I've rediscovered it in the sense, but like I said, I had a license in the 70s to do whatever I wanted, and I've got to the point where I became obsessed with the markets, and I didn't find much information in the public domain. And what I did find, I had a strong appetite for, and I wanted to improve upon and perfect. Back in 1971, 72, I got introduced to the bank credit analyst, and it was a fellow by the name of Tony Beck out of the Bahamas and also out of Toronto. And I got talking to him, and I asked him at the time, because there was a mention of a guy named Hamilton Bolton, and I contacted him, and I said, I said, can I speak to Hamilton Bolton? I said, do people know about Elliot? He said, not really. I said, well, Hamilton Bolton wrote a piece not too long ago, and he said, yes, Hamilton knew it. And I said, may I speak to him? He said, no, he passed away. And I said, well, whom can I speak to? And he said, you might want to try a fellow by the name of Jack Frost, who's a traveling tax judge in the Quebec province, or I can't remember what province it was in Canada. So I contacted him, and like I said, I was pretty cocky. I had a lot of money to give, and I offered him to invite him down to the States to give a presentation. And he said he really didn't have time, but he could give me 2 names of people whom had worked with him more by correspondence regarding Elliott Wave. And he gave me the 2 people's names. They're both physicians down in Florida. One was from Merritt Island, Florida, and one was from Wildwood, Florida. The first one, Wildwood, Florida, they're both physicians, and I contacted the first one and invited him to Milwaukee, Wisconsin. And the only time he could come was a Friday evening. So I talked to all the professionals in the firm who had a life, which I didn't at the time because I was so obsessed with the markets. I invited him into our conference room to give us a presentation. I talked it up within the group, and I said, we really got to get into this, and it's important. I really didn't know much about it. Well, I went to the airport to pick up this doctor, and I remember it was about 4 or 5 in the afternoon, and it was a flight, Eastern Airlines from Florida to Milwaukee, and I walked up and down the concourse, and everyone had deplaned, and I called his office, and they were an hour ahead of us, and I said, geez, the doctor's not here. It's going to embarrass me. I said, I thought he was coming. And his assistant or nurse, whoever answered the phone, or his wife, said, he'll find you. Don't worry. So what happened, I kept walking around. All of a sudden, this guy with a long gray beard and shabbily dressed walked up to me and said, you must be Tom DeMark. And I said, yeah. He said, do you know how I know? And I said, no. He says, you're walking in Fibonacci angles. So from then on, I knew that there was a dark side to this industry. And this fellow came into the office, and he had a loose leaf folders, a number of them, and he had the Fibonacci numbers. He was going to show us Elliot, and it was embarrassing. He had 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, on and on. And he was going through the Dow Jones average since inception and identifying what he called were waves, Dow Jones waves. And it was embarrassing. I thought I was going to lose my job. And the following Monday, the guys told me, be more circumspect in the future. Be careful who you invite in. And so I wanted to pursue this further because I was fasting with Elliot. I called the other doctor, and he was in Merritt Island, Florida, talked to his nurse, and she said, he's busy, but what's it regarding? I said, Elliott Wave in Fibonacci. He jumped on the phone quickly, and I said, do you know much about Fibonacci and Elliott Wave? He said, yeah. He said, I've been married 5 times, I have 8 kids, and every 13 days I take a vacation. So I knew for certain that these were not the guys I wanted to work with, but nobody else knew anything about it. And I had just gotten married at the time. My wife bought me a book on, because what I did, I went to New York then, and out of the archives, from archives in the New York Library, I was the one who retrieved the original Nature's Law by Arion Elliott in the magazine in 1946, and I got that copy, passed it around. I remember I gave it to Bob Farrow, who was in charge of technical analysis at Merrill Lynch, who gave it to Dick McCabe, and I passed it on to a lot of people. And that one copy, or the copy of that particular treatise, was really propelled my career, because in 1976, 77, I remember I received a call or a contact from Bob Prechter, and I talked to him, and he said he was going to have a service for $144 a year, or 6 months, and $233 a year, and I didn't think it'd be successful. And I said, I got just the first 2 subscribers for you, the 2 doctors out in Florida. But he made a real career out of it. He was successful with it. And then I met Paul Jones through that particular article, and I met a number of other people because I had my name up on top, and it circulated around the industry. So, but what I found is that Elliot and Bob Prechter, I don't know anyone else who's a real expert at it. It was totally subjective. as far as I was concerned. So what I introduced, because Elliot is composed of Fibonacci numbers, I had an approach whereby, for example, just to go through real quickly, a wave would not be complete unless you had an eight bar high or eight close high, and it was followed by a 5-bar low, or an 5-bar closing low, and then the next high would be defined with a 13-bar high or a 13-bar closing high, and then the pullback would be an 8, and then a 21-bar high, and that defines the waves. And from there, you're able to make projections, and it's totally mechanical. So that's my approach to Elliott Wave. We call it D Wave, and we do have it with our indicators. In fact, we've got a new service now called DeMark Prime, in addition to Bloomberg and CQG and Thompson. And in there, that wave analysis has been detailed. There's a lot of detail devoted to the construction of the wave, but that's essentially it.
Yeah. Gosh, Tom, this is clearly a topic I should have brought up at the beginning of the interview and not at the end. We're just about out of time. Actually, we are. But I can't let you go without at least a quick comment on where you think the markets are headed for the remainder of the year. Right now we're down about 2.5% on the S&P today. Could this be the bottom of the correction, getting ready for a summer rally? What do you think?
We don't see it yet. We're mostly focused on short term. We did fulfill what I call TD propulsion today on the S&P. That downside was 1039.60. We've been following that very closely off this recent high. If you look at the FTSE, the CAC, and the DAX, they all had a sell setup at this recent high 2 weeks ago. The recent highs. The sell setup meaning 9 consecutive closes greater than the close 4 bars earlier. At the same time, they each traded up to a disqualified TDST level. And the TDST level is defined as the highest price, in this particular case, of the prior bar setup to the downside. And it ran into resistance because it was disqualified. And the same thing today with the propulsion on the downside is disqualified. By disqualified, I mean most people who work with breakouts, I think, are looking at them incorrectly, in the sense that if a market is down yesterday, because of human nature, they project their feelings because they're probably short, and once you get to a critical level, that's a breakout level, they say for certain that that's the breakout. When in fact, if yesterday were an up close, and then you broke out below an important level today, that would be more symptomatic of a breakdown, because most people perspective was that the market was going to go up because they are creatures of habit, when in fact the market turned down. And that's what we run into right now. Getting back to where we are, we don't like to give out advice, but currently we're day 6 of a buy setup, and that buy setup ran into a disqualified low today, so we should probably get a rally beginning probably tomorrow. But we are looking at a buy setup 9 coming up, and that would require 3 more closes less than the close 4 bars earlier. Today is day 6. Tomorrow would be day 7, which would be Wednesday. Thursday and Friday should be some sort of low. In order to perfect the buy setup, the low of day 8 or 9 must be less than both of the lows of 6 and 7. So we should see a rally there beginning Friday, it looks like.
I see. All right.
But it's kind of confusing unless you have a chart in front of you. If we had a chart, unfortunately, I could probably identify them better. But
that's the downside of doing an audio interview, and that's why we focus on these things that we do. Tom, I want to thank you for taking the time to do this interview. I know it's a busy day for you. Is there anything else you'd like to mention before we go?
No, I think it's great what you're doing. I think if I had the opportunity to get educated while I was starting in the business, and I had the access to something other than pre-Bowmar calculator TI-57, and I was using I was required to do everything by hand, and I had to pour over charts. But I think what you're doing is great. It's great for the industry. It's great for technicians and market timers, and I really applaud what you're doing.
Oh, that's wonderful. Today's guest has been Tom DeMark, and that wraps up today's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson with our recording engineer, Shane Squark in New York City. Say goodbye, Shane.
So long, everybody.
Let's keep our stops tight. Good day.